Many analysts are urging investors to avoid Chinese stocks at least for the next 12 months as the Chinese regulatory actions in the technology and private education sectors has sent the Chinese stocks a massive sell-off. On July 28, news reported that ARK Invest's Cathie Wood sold nearly all its positions in Chinese stocks. Should you sell your Chinese stocks if you are still holding some? Or should you completely avoid Chinese stocks? Currently Alibaba, Tencent, Baidu and JD.com are slid heavily into undervalued territory compared with their fair value estimates. This may not be the end of Chinese stock as on July 28, the China securities regulator told brokerages that China will continue to allow Chinese companies to go public in the US as long as they meet listing requirements. Hedge fund billionaire Ray Dalio posted his view on LinkedIn on July 30, urging investors not to misinterpret the recent China crackdown moves as anti-capitalist. He recommended continuing to gain exposure to China regardless of regulatory uncertainty. So, if you would like to invest in Chinese stocks, think long-term. Carefully select the best from the rest to invest, as this could be a lucrative investment opportunity if you are a long-term oriented investor. Alibaba is a potential and good company. It recently reported earnings. Let's do a study on Alibaba. Alibaba Group Holding reported its quarter-end, June 30 revenue of $31.9 billion. This is an increase of 34% year-over-year, but below the estimates of $32.4 billion. It is no doubt that this revenue has taken the hit from the recent China crackdown on online commerce, ride-hailing, and education tech. Its active consumers have reached 1.18 billion, which is equivalent to a 45 million increase. However, its income from operations has seen a decrease of 11% year-over-year to $4.8 billion. Alibaba said that the decreases were due to an increase in investment to the pursuit of growth that has yet to gain traction. As an e-commerce company has a very thin margin, hence the decrease in operating income could be a big concern for the company. Alibaba has diversified its business since it was IPO in 2014. In order to convince investors, Alibaba is required to show strong growth of operating income. Let's look at its business. Alibaba's local retail marketplaces recorded solid physical goods gross merchandise value, GMV, growth that reflected strengths in categories such as apparel and accessories, home furnishing, and consumer electronics. Alibaba's Lazada business posted a record of over 90% year-over-year order growth for the quarter. This implies that Alibaba is on track on penetrating Southeast Asia e-commerce markets. Besides its e-commerce business, I would be more focused on Alibaba's cloud computing business performance. This sector is a high-growth sector and better margin compared to Alibaba's e-commerce businesses. For the quarter of June 2021, Alibaba's cloud computing revenue achieved 29% year-over-year growth and reached $2.5 billion. However, Alibaba said that its cloud computing revenue has slowed for the second consecutive quarter due to some major customer withdrawals. The loss of major customers, which belief is TikTok parent ByteDance, significantly affect its cloud computing business. I would suggest closely monitor the cloud business revenue and margin progress. During the call, the Alibaba board also announced to increase the share repurchases program from $10 billion to $15 billion. This will be a good boost to the share price and further improve Alibaba Group's balance sheet. Alibaba shares fell to a 16-month low in July, as investors fear the risk of Chinese stocks delisting. China regulators continue to expand the crackdown and launched an investigation on 34 internet giants. Following the crackdown, Alibaba has made tentative steps at opening up its ecosystem to allow WeChat Pay to be used for payment purchases on its Taobao and Tmall. These moves provide the assurance to Beijing on resolving the anti-competition concern, as historically both Alibaba and Tencent barred each other's services on their own platforms. Alibaba's strong efforts to add value to consumers and sellers through product enrichment efforts and platform innovations have driven its e-commerce active users' growth, but these investments have given a hit to its operating income. Its cloud computing business is somehow disappointed. If Alibaba could not strengthen its position in the cloud computing segment, the stock future will be very uncertain. Investors should keep an eye on the recent regulatory changes in the China internet industry and the expected impact on Alibaba, especially over the long-term development. Hence, Alibaba's next two-quarter earnings will be very important to further assess its stock future. Recently, Roku stock fell more than 7% after reporting earnings. Roku is a good stock to own. It was overvalued when its stock price traded above $450. Recently the stock fell below $400. Let's look at Roku now to see if this is the right opportunity to buy the dip. Roku reported its Q2 earnings on Wednesday. Its top and bottom lines exceeded expectations, but user growth came up short, hence share fell more than 8% in after-hours trading on Wednesday. The question investors are worried about is, can Roku maintain its historical growth rate? Can Roku continue to sustain high revenue and profit after the pandemic boom coming to the end? Investors are worried about Roku's user growth and the number of hours streamed. Its active customer accounts were reported at 55.1 million, below the estimate of 55.8 million. In the June quarter, Roku only added 1.5 million new users, but Wall Street was expecting 2.1 million new users to be added. Roku's streaming hours also decreased by 1 billion hours from the first quarter of 2021, totaling 17.4 billion in the second quarter, which missed estimate of 19.19 billion. Its average revenue per user increased 13% to $36.46 in the second quarter, and average revenue per user rose 46% year-over-year. As economies reopened and more out-of-home entertainment activities such as dining and travel in the second quarter hurt Roku's user growth. However, if we assess Roku's business, it is no doubt that subscribers will not continue to grow like the year 2020. If we would like to invest in this stock, the question we should ask is how sustainable Roku could maintain its revenue and margin, with sustainable growth exclude the pandemic-fueled acceleration. Roku's platform is likely to continue to benefit from the adoption of smart TVs and streaming in general. Roku is selling its hardware, the Roku Streaming Box or Roku OS Smart TV, potentially locked in its users, as the subscribers already invested upfront on these devices, result in the switching cost is expensive to its subscribers. Roku has benefited from video streaming industry growth as people are continued shift away from traditional media. The industry has spawned a record number of new user signups, not only across services like Netflix, but also Apple TV+, Disney+ platform and Time Warner's HBO Max. These services are benefiting Roku as Roku sells streaming devices, earning from subscriptions and advertising dollars. According to Roku's Q2 earnings report, Roku mentioned that the supply chain constraints and cost increases with its streaming players and TV partners will hurt its potential sales and profit margin. However, this will be a short-term challenge for the business. I will not be too concerned about it, as Roku's hardware revenue is less than 30% of its total revenue. Its platform revenue is still the key for its business. Earlier this year, Roku bought the short-lived streaming platform Quibi. Roku rebranded all of Quibi's content as Roku Originals. This is a big move for Roku to create exclusive content for its channel, which could improve its ad-supported streaming services. This will also extend Roku's platform business to attract more advertisers and partners, increase its subscribers. Roku is constantly gaining market share and improve its advertising revenue. Hence, Roku's long-term outlook is great. The near-term challenges cannot be avoided and the roller coaster stock price will be temporary. Do not miss the great long-term opportunity. Hope you enjoy the video. This is not a financial advice. The content of the video is for reference and entertainment purposes. Please do your due diligence before making any investment. Thank you for watching. I am Max from Market Pulse Studio. Please like and subscribe. Have a nice day and thank you.